Welcome to The Wealth Architects. This is the best spot if you're seeking information on everything related to finance. We offer you it all. In this video, we'll be specifically focusing on ETFs and passive investing. We present you a list of the top 5 ETFs available for passive investing. First of all, it's important to have a brief understanding of what are ETFs and passive investing before we go further into the topic. What is ETF? ETF is the shortened term for Exchange Traded Fund. It's a type of fund that trades on exchanges. How does ETF work? Basically what happens is, once you invest in an ETF, you get a pack of assets that you can purchase or sell during market hours. They are structured as investment funds that merge investors' money to purchase a diversified portfolio of assets or stocks, bonds, commodities, or other financial instruments. The performance of an ETF can be influenced by factors such as market conditions, index tracking errors, and inherent asset volatility. Next, what is passive investing? Passive investing is an investment strategy that targets to repetition that performance of a specific market index or asset class. What happens in passive investing is, investors pursue to correspond the returns of a benchmark or index by holding a varied portfolio of securities similar to the composition of the benchmark. Passive investing has gained popularity due to its minimalism, lower costs, and extensive market exposure that comes with steady returns over the long term. Passive investing through ETFs refers to using ETFs as the primary investment mechanism for implementing a passive investment strategy. Investors intend to repeat the performance of a specific market index or asset class by holding a diversified portfolio of ETFs that closely track the desired standard. Now that we have a brief understanding of the basic concepts, let's get to the main topic of the video. Here's a list of the top 5 ETFs investors can utilize for passive investing. The first ETF on our list is the Vanguard S&P 500 ETF. Referred to as VOO, the Vanguard S&P 500 ETF is one of the most popular and widely recognized ETFs for passive investing. It tracks the performance of the S&P 500 index, which represents 500 large-cap US companies from numerous sectors, signifying approximately 80% of the total US stock market capitalization. Investing in VOO allows investors exposure to a diversified selection of companies across several industries. Technology, healthcare, finance, and consumer goods are a few to name. One significant advantage of VOO is its low expense rate, which is at 0.03%, a notably lower ratio compared to the average industry of 0.24%. This lets investors have exposure to the largest US stocks for a considerably minimal cost of $3 annual management fees per $1,000 invested in the ETF. It uses a market weight strategy that gives a higher increment to the largest companies. Over the long term, the S&P 500 has delivered solid returns, with VOO showing only slight underperformances since its inception. It is one of the best choices for investors. The second ETF on our list is the iShares Core MSCI AEFE ETF. This is an ETF concentrating on international stocks. It is referred to as IEFA. It tracks the MSCI EAFE index, which represents developed markets outside North America, including countries from Europe, Asia, and Australia. This enables investors to have international variation in their portfolios. As of early 2023, IEFA holds shares of over 3,000 stocks. It is diversified by sector and geography. While financials, industries, healthcare, and consumer discretionary are some of the top sectors, the top geographies in the ETF are Japan, the United Kingdom, France, and Switzerland. IEFA also charges a considerably low expense ratio of 0.07%, so with a minimal cost management cost, investors can benefit from the evolution of the global economy. Also, investors gain exposure to a diverse set of companies across various sectors in developed international markets through IEFA. This ETF follows a market cap weighted index methodology, which allows larger companies to reflect their size and influence in global markets. The third one in the list is the Invesco S&P 500 Equal Weight ETF. It also tracks the stocks in the S&P 500. Unlike the traditional market cap weighted method, this ETF, referred to as RSP, is utilized with an equal weight approach. This means that each stock in the S&P 500 index is given the same weight in the portfolio, providing equal representation to all companies, disregarding their market capitalization. This allows RSP to give more prominence to smaller companies as well as more diversification within the S&P 500. This could lead to potentially lesser concentration risk. RSP has shown potential for outperforming the traditional market cap weighted S&P 500 index over the years. This is due to smaller companies outperforming larger companies in certain market conditions, and they have a higher weight in RSP. This ETF also has a relatively low expense ratio of 0.2%. The Schwab US Dividend Equity ETF is the fourth one on this list. Referred to as the SCHD, the ETF tracks the performance of the Dow Jones US Dividend 100 Index. The index focuses on dividend-paying stocks from the US equity market, aiming to include companies with a history of consistent dividend payments and potential for future dividend growth. SCHD is designed to provide investors with exposure to high-quality US dividend-paying companies. 40% of the total is made up of the top 10 holdings of the ETF. Overall holdings are weighted majorly in tech stocks and the financial sector. The ETF charges a considerably very low expense ratio of 0.06%. This lets the investors keep a notable percentage of dividend income, which is produced by their holdings. SCHD also offers a dividend reinvestment feature, which indicates that dividends earned from the underlying stocks are automatically reinvested in the fund. The ETF mainly invests in large-cap companies, while investors are exposed to mid-cap and small-cap stocks as well. The fifth and the last on our list is the iShares Core S&P 500 ETF. It tracks the S&P 500 index denoted by IVV. The ETF is designed to provide investors with broad exposure to the US equity market by investing in the 500 largest US companies. It follows the market cap weighted index methodology, so as discussed before, larger companies have a higher weight within the index. IVV is a favored choice for passive investing, aiming to capture the overall returns of the US equity market. By investing in IVV, investors can obtain wide exposure to an expanded portfolio of large-cap US companies. At a low expense ratio of 0.03%, this ETF is cheaper than most options in the market. IVV is the second largest ETF by assets and commands more than $300 billion. These ETFs are only a few of the many ETFs available for passive investing. Investors should consider their own capacity to face risks, investment goals, and time horizons before deciding on the most suitable ETFs for their portfolios. Thank you for watching, and don't forget to subscribe.